Yeah, I mean, these cookies are huge, but they're still only $12 for 4 of them. So if they're asking for $10 at the exchange, that's an arbitrage opportunity. Oh, hey, you're here. Good, because I have so much more I want to teach you guys about order flow. In fact, I think this series is going to have more videos than I originally intended. Today, though, I want to give you some real tangible edge. And we're going to go into serious detail, so even some of you old hats might get something out of this video. We're going to cover 2 setups that can give you more favorable entries: catching the edge and icebergs. So you know those trades where price never even goes a tick against you? These edges can help you catch more of those. Now, I don't want to oversell it. The edge these setups give you on their own is tiny. They're more about optimizing your entries when you're making a trade based on a larger edge. However, what makes these setups special is that they are structural edges. That means that they take advantage of the inefficiencies caused by the very rules of the market. So that means that not only can we prove they are edges through simple math and logic, but we can also know that these edges will always exist unless the structure of the market changes. That makes these 2 setups the perfect foundation for understanding order flow, because it's getting down to the very heart of how the game works. So I'm super excited. Hi, I'm Speculator Seth, and by the way, thank you so much to everyone that watched and commented on the first video in this series. It's tracking to be one of the top videos on the channel, so keep it up, guys. The engagement is a big part of that, so make sure to ask questions and leave your own tips about icebergs and catching the edge in the comments below. With your help, we're creating possibly the best resource on this subject out there, so please keep it up. Also, I'd love to know what you think about the chalkboard setup. I'm using a different mic and everything so that I can move around and point at things. So let me know what you think of it. Anyways, I have a picture of my jigsaw DOM drawn up here. So if you are not familiar with what all of these columns mean, please refer back to the first video in this series. I should also note that not all software has these middle columns that we call current trades to show market orders. It's mainly a jigsaw thing, although you can duplicate it in Sierra charts and others. If you don't have these columns, then you will have to watch the volume profile to determine how much is trading at that price. Obviously, it's a lot easier to just have the column, which is part of why I love Jigsaw so much. And as always, want to note that I am a Jigsaw affiliate. If you purchase the software through the link in the video description, I get a commission that helps grow the channel, so I really appreciate it. So let's get started with our first example. So here we have the best bid and the best offer, and there's always a lot of interest around these 2 prices because that's where the market orders are going to be matching against. So usually there's a little less liquidity at these inside prices, and usually one side will be stronger than the other. And this is really important because this affects how likely those orders are to get filled. So in our current example, you can see that there is a lot more on the bid with 2,000 than there is on the offer with 500. So think about it. What is more likely to happen? That 500 market buy orders come in and hit into that ask, moving price up, or that 2,000 market sell orders hit into that bid and move price down? Well, of course, either could happen, but because it requires less volume to lift that offer, we are much more likely to tick up. The smaller that offer is compared to the bid, the more likely it is to get taken out to a point where it's practically guaranteed to happen. Knowing this, traders will hit into that 500 to intentionally move it up. And this is called catching the edge. So we'll see something like 500 lots come in and take this out, and 500 lots stack on the bid. So if you caught the edge and bought at that price, you're now long at 28 with the ability to sell back into 28 and get out at break even if you have to. See, normally using a market order has a big disadvantage. You're giving up the spread. If you buy with a market order and price doesn't tick up, then you have to lose a tick to get back out. And this might not seem like a big deal, but it can make a huge difference. You'd think that if you just took a random trade with equal risk reward, that you'd have a 50% chance of winning on the trade. But because of the spread, it's really more like 40 to 45%. When we're able to catch the edge, we're canceling out that disadvantage and turning it back into more of a 50-50. Now, of course, for you to actually make money after that, it has to keep going, right? Otherwise, it's just the opposite situation. The offer is $2,500 and the bid is $500, so we're more likely to tick back down. So after we tick up, we want to see continued pressure. That means some combination of orders adding on the bid, which we call stacking, orders at the next offer canceling, which we call pulling, or market orders starting to hit into the next offer. Of course, you can't guarantee that you'll see that continued pressure. The traders that moved price up don't necessarily know anything. They were just trying to catch the edge. However, if you're going to take a trade, it is always to your advantage if you are able to catch the edge. So what we want to do is combine this with other larger edges that we might have. For instance, news and sentiment that gives us a clear read on what direction we should move on that day. Then we're more likely to see that continued pressure after getting in. And if we don't start to see that pressure, we can just scratch. Often though, the problem will be more about being fast enough. That's where, again, Jigsaw is just so awesome, and it has a feature called a volume stop. This is an order that will trigger if the queue at that price goes below a certain threshold. So for instance, if we set our threshold to 500 lots and some orders cancel here so that there's less than 500 orders on the offer, then our order will trigger. When using a stop volume order to catch the edge, I would recommend setting it to a stop limit order. That way, if the liquidity gets taken out before your order is submitted, your order will just go onto the new queue. If you miss price, at least you'll be at the front of the queue with a better chance of getting filled. From there, it's a matter of deciding what threshold to use. And for that, you'll find that the queues have a tendency to balance out at certain levels. There's actually some math behind why this happens, but you don't need to go into that. You'll see it very clearly as you watch the action. In the 10-year treasury, 2,000 lots is pretty stable. If we get below 1,600 or so, we're more likely to see price change. And if we get below 500, then we're extremely likely to see price change. So you can set your threshold to some random number between those levels based on how concerned you are about getting left behind. Don't pick a number that's too obvious though. Part of the game is market makers constantly stacking and pulling to see if they can get orders to trigger prematurely. Really, you do have to think of it as a game. It's like rock, paper, scissors, where you have this constantly evolving metagame. So what I just showed you is kind of like rock, the move that almost everyone picks at their first time playing. So what does paper look like? Well, let's go back to our example where, again, we have 500 lots on the offer. You want to catch the edge, so you and 500 market orders hit into that price. Except this time, instead of clearing the price, you immediately see 500 more lots stack onto the offer. And you'll see that number just keep increasing all the while the offer stays at 500, but 3,500 contracts have gone into it. What's going on? You've just run into a refreshing or iceberg order. This is a type of order provided by the exchange that only shows a portion of the full order at a time. As that portion gets filled, the order will then automatically refresh and show more. The result is it takes a ton of market orders to get through that price. In this case, I put 3,500, but it is not uncommon to see 5,000 or 10,000 lots in the 10-year, 1,000 to 3,000 lots in the S&P 500. Now, the cool thing about an iceberg is that you can sneak your own order in there and join the iceberg. Say, for instance, you wanted to sell, you can put your order right there on that offer, and you have a really good chance of getting filled because there's only 500 lots on there. And when the order refreshes, those new lots will be behind you. This is great because you get a spot where the queue is small for a more likely fill, but the iceberg means that it will require more volume than usual for price to tick through you. So this makes it a great place for a limit order, especially as an exit on a small scale. Be careful about assuming that the iceberg will always hold, though. Icebergs are often hedges or trades that aren't driven by informed trading. The trader placing the iceberg wouldn't put it there if they didn't have a reason to think that they would get filled. So there's still a good chance that they will make it through the iceberg. And when they do, there's often a little bit of a stop run. So just like with catching the edge, seeing this setup doesn't necessarily mean that there's some increased probability of it moving up or down. I mean, there's a slightly higher probability that price will hold at that location, but it's very minute. Instead, you're just playing the queue to get a slightly better entry. So if you're looking for a place to get short and then you see the iceberg, that could be a good opportunity to get in. Now, these are both setups that I would practice trading on. Here again is where Jigsaw is really great because it has a much better simulator than most other trading apps. It simulates the queue positions accurately. Actually, it's a little bit more stingy on the fills than a real trade would be. So try trading a session on Sim where you try to catch the edge as many times as possible, or you try joining every iceberg that you see. You could even try watching for an iceberg and trying to catch the edge when you see that iceberg fail and price go through. As you do this, give yourself minimal stops and targets that are equal to each other. So when I do this in the 10-year, I'm only looking for one tick. Don't stress too much about the win rate because the goal here is just getting comfortable identifying the situation. With such a short-term, purely technical signal, there's always going to be a lot of randomness to it, and you're probably going to get a win rate around 50% if you're doing things right, depending on how trendy of a day it is. That's good though, because remember, random would be more like 40 to 45%. So if you're getting 50%, that's awesome. These two setups are really foundational to how the market works. And there are a lot of robots out there that are literally just trading on variations of those two setups. So it's really worth putting a little bit of practice time into identifying and understanding those situations because it kind of forms the basis of everything else that you're going to do with order flow. So try dedicating a session or two just to those two setups. And then in the next videos, we'll be talking about large orders, various market conditions, and proven order flow tendencies. I will see you guys when I'm streaming every morning starting at 8:20 Eastern Time. In the meantime, stay profitable, friends.